have you ever pondered how certain individuals manage to generate income while they sleep? It's not a riddle. The truth is, to maintain financial stability and avoid debt, you must earn money around the clock, whether you're sleeping, eating, or at the gym. To achieve this, your investments must work tirelessly day and night. In today's video, we present an investment strategy that is not only straightforward and profitable, but also sustainable: dividend investing. Dividend investing entails owning shares in companies that regularly pay you a portion of their earnings. Imagine yourself as a silent partner in a successful business, reaping the rewards of its prosperity without actively participating. Additionally, we've carefully selected the top 4 dividend stocks for investment in 2024. Which stocks are these? Let's delve right in. What defines an exceptional dividend stock? As we delve into the investment realm, one term frequently emphasized is dividend growth, and with good reason. Essentially, dividend growth refers to companies increasing their annual payouts to shareholders. This isn't a one-time occurrence, but a consistent upward trend that mirrors the company's growth, profitability, and stability. Why is this significant? It signifies the company's robustness and dedication to delivering value to shareholders. In a world that values financial stability, companies that pay dividends and consistently boost them are highly coveted. They offer a dual benefit: regular income through dividends and potential investment growth as the company prospers. Now, let's discuss the advantages. Investing in these dividend growth companies is akin to planting a tree and reaping its fruits year after year. Initially, the dividends may seem modest, but with each increase, your income grows gradually. This can culminate in a substantial source of passive income, aiding in wealth accumulation and securing your financial future. It's not merely about immediate dividend gratification, but rather the foresight of creating a sustainable and expanding income stream. But why opt for dividend stocks? With dividend stocks, you gain both growth and stability crucial for a brighter financial future, all while earning income. With that said, let's explore some dividend stocks worth considering and investing in. Beginning with the iShares Core Dividend Growth ETF, also known as DGRO. DGRO is a $25.8 billion ETF managed by BlackRock's iShares, designed to track an index comprising S equities recognized for consistently increasing dividends. These companies hail from various sectors, ensuring broad investor diversification. When a company steadily increases its dividends, it typically signals steady earnings growth, rendering the stock appealing for both dividend income and potential capital appreciation. DGRO provides investors with a diverse range of dividend-paying stocks while mitigating concentration risk, with its top 10 holdings representing only 26% of its assets. This blend of consistent dividend growth and diversified holdings makes DGRO an enticing choice for investors seeking stability and potential returns. As of December 31st, 2023, the fund achieved an annualized return of 8% over 3 years and an impressive 12.9% over 5 years. Examining cumulative returns, DG demonstrates a strong overall performance with an incredibly low expense ratio of only 0.8%. Investors incur a mere $8 in fees per year on a $10,000 investment. Assuming this consistent expense ratio and a 5% annual return, an investor putting $110,000 into DG would only pay $100 in fees over a 10-year investment period. This cost efficiency renders DGRO and similar low-cost ETFs indispensable for investors, enabling them to save, earn, and steadily expand their portfolios over time. The WisdomTree's Quality Dividend Growth Fund DGRW was launched on May 22, 2013. It belongs to the smart beta category of exchange-traded funds, providing extensive exposure to the large-cap value segment of the market. But what exactly are smart beta ETFs? Historically, the ETF industry has been dominated by products based on market capitalization-weighted indexes that aim to mimic the market or specific segments of it. Market cap-weighted indexes are favored by investors who believe in market efficiency, as they offer a low-cost, convenient, and transparent method to replicate market returns. However, some investors believe in the potential to outperform the market through strategic stock selection, leading them to invest in smart beta funds that track non-cap-weighted strategies. Smart beta indexes share similar philosophies, striving to select stocks with superior risk-return potential. Instead of relying solely on market capitalization, these indexes base their stock selection on specific fundamental characteristics or a blend thereof. The smart beta landscape provides investors with various options, ranging from straightforward equal-weighted strategies to more complex approaches like fundamental and volatility-based weighting. Expense ratios play a vital role in determining a fund's overall return for ETF investors in the long term. Lower-cost funds have the potential to outperform their higher-cost counterparts, assuming all other factors remain equal. This ETF boasts annual operating expenses of 28%, aligning it with most other similar products in the market. Additionally, it offers a 12-month trailing dividend yield of 167%. DGRW's largest allocation is in the information technology sector, comprising approximately 28.9% of its portfolio, followed by healthcare and industrial sectors. Among its individual holdings, Microsoft Corp constitutes around 784% of the fund's total assets, followed by Apple Inc. and Johnson & Johnson. The top 10 holdings make up roughly 37.92% of the fund's assets. DGRW has delivered a return of 8.88% over the past year as of March 1, 2024, effectively diversifying company-specific risk with around 300 holdings. The Vanguard Dividend Appreciation ETF VIG is another smart beta exchange-traded fund that debuted on April 21, 2006. Managed by Vanguard, it offers broad exposure to the large cap blend category of the market, with assets exceeding $75.62 billion. VIG also ranks among the largest ETFs in this category. The fund seeks to replicate the performance of the Nasdaq's Dividend Achiever Select Index before fees and expenses. The Nasdaq's Dividend Achievers Select Index consists of common stocks of companies with a history of consistently increasing dividends over time. VIG stands out as one of the most cost-effective options, with annual operating expenses of just 0.6%. Additionally, it provides a 12-month trailing dividend yield of 179%, offering investors attractive income potential. So, what are some of the assets held in the fund? The largest allocation in the portfolio, making up 23.5%, is in the information technology sector, with financials and healthcare following as the next significant sectors. Among specific holdings, Microsoft Corp represents about 5.54% of the fund's total assets, followed by Apple Incorporated and JP Morgan Chase & Company. The top 10 holdings together constitute approximately 32.16% of the total assets under management. Regarding performance, the ETF has shown a gain of around 13.75% year-to-date and 18.53% over the past year as of March 1, 2024. With a beta of 0.8 and a standard deviation of 15.11% for the trailing 3-year period, the fund is considered a medium-risk option within its category. With roughly 318 holdings, it effectively spreads out risk. Another excellent investment option for investors seeking a blend of income and growth is the Schwab's Dividend Equity ETF SD. Launched on October 20, 2011, this passively managed exchange-traded fund sponsored by Charles Schwab has accumulated assets exceeding $53 billion, making it the largest ETF aiming to mirror the large cap value segment. Large cap companies typically have market capitalizations exceeding $10 billion, providing stability and more predictable cash flows compared to mid and small cap counterparts. Value stocks, which are the focus of this ETF, are characterized by lower than average price to earnings and price to book ratios. However, investors should note their comparatively slower sales and earnings growth rates. Despite this, value stocks have historically outperformed growth stocks over the long term, albeit potentially lagging during strong bull markets. How does this ETF perform? With an annual operating expense of only 0.6%, SD stands out as one of the most cost-effective options in its category. Additionally, it offers a 12-month trailing dividend yield of 3.40%, providing investors with attractive income potential. Its largest allocation is in the industrial sector, making up approximately 17.30% of the portfolio, followed by financials and healthcare. Among specific holdings, Broadcom Inc. represents about 5.09% of total assets, followed by Abe Inc. and American Co. Inc. The top 10 holdings collectively make up around 42.2% of the total assets under management. SD aims to replicate the performance of the Dow Jones Dividend 100 Index before fees and expenses. This index assesses the performance of high dividend yielding stocks issued by S companies with a consistent dividend payment record, selected based on their fundamental strengths relative to peers as determined by financial ratios. Passively managed ETFs are gaining popularity among both retail and institutional investors due to their low costs, transparency, flexibility, and tax efficiency, making them excellent options for long-term investors. But how can you construct a diversified dividend portfolio when investing? Creating a diversified dividend portfolio is a crucial step. It's not just about assembling stocks that pay dividends. It's about balancing yield with growth, stability with potential, and spreading investments across sectors and regions to manage risk by incorporating a mix of ETFs like those discussed. Investors have access to a wide range of companies across various sectors with just a few investments. These ETFs, each with distinct selection criteria and sector exposures, establish a strong foundation. However, the key lies in how you blend them together. A well-rounded portfolio may distribute investments among these ETFs based on their performance, dividend growth rates, and sector emphases, ensuring that the impact of any single investment's decline on the overall portfolio is minimized. While the allure of high dividend yields can be enticing, astute investors recognize the importance of equilibrium. High yields often come with elevated risks or the potential for future dividend reductions. Therefore, it's crucial to include ETFs and stocks that not only offer high yields, but also exhibit consistent dividend growth and stability. For example, VIG's focus on dividend growth stocks balances out the allure of high yields from other investments, providing both growth potential and stability to the portfolio. Diversifying across sectors ensures that your investments are spread out across different industries, from technology to healthcare, consumer goods to energy. This strategy helps reduce the risk of sector-specific downturns, significantly impacting your portfolio. Additionally, while less emphasized in portfolios focused on dividend stocks and ETFs, geographic diversification can still play a role. Considering global dividend-paying companies or ETFs that track international markets can expose you to different economic cycles and opportunities, further diversifying risk. Ultimately, constructing a diversified dividend portfolio is an ongoing process of evaluation and adjustment, not a one-time task. It involves staying informed about market trends, assessing your investment's performance, and being prepared to rebalance your portfolio as necessary to align with your financial objectives and risk tolerance. What are your opinions on these notable dividend stocks? Share your thoughts in the comments below, and be sure to like this video and subscribe to our channel for more insightful content. Until next time, happy investing!